Hi everyone, welcome to Investing Club. In today's video, we're going to talk about the dangers of owning these so-called high growth stocks. Now, if you've watched my previous videos, I'm someone who doesn't think it's a good idea to invest in stocks that are trading at PE ratios of 50, 60, 70, all the way up to 100 and even more than 100, regardless of how fast these companies are growing. Because while it is true that maybe at the moment, there are certain companies that are growing revenues at 50, 60, 70% a year. Companies don't keep growing that fast forever. Eventually, growth slows down. And so whatever your favorite high growth stock is out there, the growth is probably going to slow down at some point, and it's probably going to be at a point where no one's expecting it. And so this is why I mainly stay away from these high growth stocks that are either unprofitable or trading at insanely high earnings, because once that growth does slow down, the stock's going to tank, as investors realize that this company won't live up to these insanely high expectations that were placed on it. And just a few days ago, we had this exact scenario play out with a stock called Alteryx. Their ticker is AYX, and they're one of these high-flying software companies that have been growing at an extremely fast pace over the last number of years. So over the past few years, this was one of Wall Street's favorite stocks. If you look at the longer-term chart, they IPO'd in 2017, and they went from around $20 all the way to a peak of around $180. So we can take a look at what happened. They had their earnings report a few days ago, and the stock dropped over 30%. And that was the largest drop in the stock price in this company's history. And if we take a look at the reason for why this stock dropped, it's pretty much the exact reason that I said. So shares of data science and analytics firm Alteryx have lost over 40% of their value in a matter of days. And while the company did top its own guidance in the second quarter, it was a disappointing report card in second half 2020 outlook, one that implies the fastest days of growth may be in the history books. So the first thing that I see is that this company actually did better than expected for the second quarter. The company's revenue growth was 17% in the middle of a pandemic, and with one of the worst economies we've ever seen. I'd say that's pretty darn good. But what made investors start panicking wasn't the company saying, for the rest of 2020, we really don't see that much growth, at least for the rest of the year and maybe going forward. And so now the 2020 expected sales represent just 10 to 11% growth compared to the 30% growth that this company has achieved over the past number of years. And so this is a classic example of what will happen to all those insanely high growth stocks out there. There's companies growing revenues at 50%, 60% a year, and that growth is eventually going to slow down. And it's not going to go to zero. In the case of this company, they're still growing at double-digit rate. Eventually, it gets to the point where the stocks bid up so much that investors are implying that the company has to keep their growth intact for an extended period of time, where it's just not possible for that to happen. And so this is what I see when I look at all the companies out there. So this is just a list of some of the software stocks in the technology industry, and you can take a look at what kind of valuations they're trading at, where you have PEs like 168, 51, 81, 67, 186, 153, and then all of them without a PE ratio means they're not making any money. So the software industry right now is one where investors have the highest expectations for these companies, that they're going to keep growing at extremely fast rates. And that's reflected in their share prices and in their valuations. And by the way, I'm not saying that these aren't good companies. In fact, software companies, in my opinion, are some of the best types of companies in the world to own. Why? Because they're asset light, they have hardly any fixed expenses, and they're able to generate huge returns on not only their equity, but returns on investment, which are some of the best qualities to look for when you want to invest in a stock. But the problem comes when it's so obvious and everyone can see that these are great companies, right? I know that they're great companies, but guess what? Every other investor does out there too. And so everyone's just going to keep buying up these stocks regardless of the price, because they see the growth in this industry. And so when that growth inevitably slows, and it doesn't have to be much, in the case of this company, it was growing at 30 to 40% a year, and now it's slowed down to 17% and projected to be a little lower. That's all it takes for the stock to drop 40%. And it's not me hating on the stock. In fact, this is a stock that I'm actually watching right now to see if it gets to an attractive price where I think it makes sense to buy the company. Where nothing's really changed about this company. They're still a great stock. They're still a great company that's still growing at double-digit rates, even though that growth has slowed. And so even though they're still not cheap enough for me to buy them, if we do see this panic continuing and investors continue to sell off this stock to a point where it gets to an unreasonably low valuation, that's when I would take advantage and potentially buy this stock. And that's my favorite way of buying these high growth stocks. Instead of buying them when their growth is at their peak and they're trading at sky high valuation, I'll wait until one day management says our growth isn't projected to be as fast anymore, the stock's going to tank, and then I'll be able to get in at a much better valuation. And so that is why I'm still watching this company as one that I potentially could take a position in the near future if the price does keep dropping. And so finally, I'm going to bring up this chart. I did have this chart up back in a previous video where I talked about, again, value investing, and if value investing is something that is irrelevant and doesn't matter anymore. And the truth is, I think value investing matters more now than ever, because if you take a look at this chart, it shows the performance of value versus growth. And what you can see is through history, it fluctuates. You have times where the line is way down and growth outperforms, and then you always see that reverse and go back above the middle line to where value outperforms. And so even though there's always periods where one outperforms the other, there's something called mean reversion that makes sure that this switch will always reverse back into the favor of the other style of investing. Mean reversion just means that prices and historical returns eventually go back to their long-term average. And if you take a look where we are right now in this chart, we're nowhere near the long-term average. In fact, this has been the best 10-year period for growth stocks in history. And so if you just follow that concept of mean reversion, what do I expect to happen next? Well, I expect very soon that we're going to revert back to the mean and value stocks will start outperforming growth stocks. And so that's just another reason why I'm not really a fan of these high growth stocks at this time. You know, in my opinion, if you ask me, I think all of these high growth stocks are going to get crushed in the next decade. Where we see this now, this economic contraction is starting to take place. And if it does continue for an extended period of time, these growth stocks won't really be growing that fast anymore. And I think this is just setting the stage for value stocks to make a comeback over the next decade. So that's really all I wanted to talk about in this video, just to show you an example, because I talk about the dangers of high growth stocks a lot, and here is a clear example of exactly what I'm talking about. So let me know what you think about this concept in the comments. Comment down below some of your favorite high growth stock and if you think their growth will slow down anytime soon. So that's it for the video. If you found this helpful and you learned something new, be sure to hit the like button, as it helps out my channel a ton by pushing out my videos to a larger audience. If you want to watch more of my videos, subscribe to the channel and hit the bell icon so you get notified whenever I put up a new upload. And with that, I'll see you on the next video.